Welcome to the Research Desk. We are convening this briefing today, March 14th, 2026, to address a critical, high-stakes asset allocation query currently facing your portfolio. The asset under our direct examination is Kweichow Moutai. As of this morning's pricing data, the stock is trading at precisely 1,413.64 yuan. At this price level, the valuation multiple stands at roughly 25 times earnings. The central tension we must resolve today is binary in its long-term implications, yet extraordinarily complex in its underlying mechanics. We must definitively determine whether Kweichow Moutai represents a temporarily derogated monopoly possessing world-class unassailable unit economics, or if it has devolved into a highly vulnerable Veblen prestige asset facing a permanent, lasting cultural and political repricing. This briefing will proceed systematically. We will establish the foundational economic realities of the underlying business, dissect both the institutional bull and bear cases, examine the most relevant historical market analogs, and finally conclude with specific, numbered portfolio allocation targets based strictly on the current available data. Let us begin by confronting the stark reality of the current valuation and the recent price action.
Right. And we really need to start by just acknowledging the sheer violence of that price action. Because, we're looking at a stock that is down 46% from its absolute peak.
Yeah, that peak was what, back in February 2021?
Exactly. February 2021, it hit 2,627 yuan.
Yeah.
And since then, over this 5-year period, we've seen the valuation multiple just violently compress. I mean, we went from this era of just absolute euphoric premium.
Right.
Right. Over 70 times earnings. And now it's sitting down at roughly 25 times.
Which,
Yeah.
25 times feels grounded, right? Relative
Yeah.
to 70.
It feels grounded, but, and this is crucial for anyone managing capital right now, the old shorthand that Moutai is forever, that heuristic is entirely broken.
Right.
The market has aggressively compressed this multiple because institutional investors they're actively discounting a permanently higher risk premium now and structurally weaker terminal growth.
Yeah.
We are not looking at a standard cyclical pullback here.
So break down what's actually driving that 46% decline then, because it's not just one thing, is it?
No, it's a confluence of factors. You've got tightening anti-corruption pressures from the state. You've got persistently weak macro conditions that are really eating into household wealth. And this slow but really undeniable structural shift in broader consumer tastes.
Right, which makes that 1,413.64 yuan per S and the 25 times multiple look well. It gives the illusion of deep value.
Exactly, the illusion of deep value. Because if you're evaluating Moutai on a pure price-to-earnings basis, you're fundamentally misunderstanding the nature of the product itself. I mean, Kweichow Moutai doesn't just manufacture and sell distilled liquor. The liquid is essentially just a vessel.
A vessel for what, exactly? Status.
Exactly. What they actually sell is social status. They sell the facilitation of high-stakes business ritual. They sell tangible political and cultural legitimacy. So when you buy this equity, you aren't just buying a claim on future beverage sales. You're investing in the durability of that very specific cultural signaling mechanism.
Okay, well, if we're evaluating the durability of a cultural signaling mechanism, we really must anchor this analysis in the most recent granular data we have. Which brings us to the Lunar New Year 2026 demand improvement.
Right, the LNY data.
Yeah, because during that Lunar New Year season spanning January and February of 2026, we actually observed a distinct, measurable improvement in both underlying sales volume and transactional pricing for premium Moutai products.
We did, yeah.
And that data confirms a vital baseline for your portfolio. The core societal occasions that historically sustain premium Baijiu consumption, specifically formal weddings, major traditional festivals, high-level corporate gifting, those occasions haven't evaporated.
No, they're still there.
Right. The demand metrics from those early weeks of 2026 show pretty clearly that the physical distribution networks and the consumer habits remain operational. The punchline of this Lunar New Year 2026 story is that the underlying product retains its physical quality and its functional demand. So the investment question isn't about the quality of the product degrading. It's whether Chinese society still desires this specific form of prestige to remain publicly valuable. And I have to interject here and really push back on this. As an allocator looking at this LNY 2026 data, I have to question the actual signal value of this bump.
Okay, how so?
Well, we're talking about a deeply ingrained holiday tradition. It mandates specific consumption patterns. So does this Lunar New Year 2026 improvement actually represent a true structural recovery in the underlying consumer base? Or, is it highly probable we're just witnessing a temporary Seasonal anomaly, like a festive clearing of wholesale inventory that's just silently masking a larger cultural sunset?
See, you've just identified the primary analytical dividing line for institutional capital right now. That is the exact tension. Because a temporary seasonal volume bump, driven by a centuries-old holiday tradition, that absolutely does not equate to a stabilization of the asset's long-term terminal value.
Right, it's a lagging indicator.
Exactly. It's a lagging indicator of tradition, not a leading indicator of future growth. A one-month clearing of inventory doesn't solve the structural issue. So, to really answer your question about whether this is a structural recovery or a seasonal mirage, we have to look at the 3 points of absolute consensus that define the institutional view right now.
Okay, let's walk through those consensus points. The first one is the economics, right?
Yeah, the first point of consensus is the asset's world-class, unassailable unit economics. I mean, let's just review the exact figures for your portfolio. We're analyzing a manufacturing business that sustains gross margins consistently above 90%.
Wow, above 90%.
Right.
Just to be clear, that implies the cost of the raw materials, the water from the Chishri River, the locally sourced sorghum relative to the final selling price. It's basically a rounding error.
It is statistically negligible, yes. And then, moving further down the income statement, net margins are sustaining comfortably above 50%.
So for every dollar of revenue, more than 50 cents drops directly to the bottom line as pure profit.
Pure profit, exactly. And furthermore, the return on invested capital, the ROIC, remains securely above 30%. I mean, these metrics are exceedingly rare in global public markets. They place Moutai in an elite, microscopic category of global enterprises. They structurally surpass almost all peers in both the European luxury sector and the American consumer staples sector.
Right. But, and this brings us directly to the second point of consensus, those formidable metrics don't negate the fact that the decline is fundamentally justified.
No, not at all.
We have to be absolutely clear here. This 46% drawdown is not just some transient market dislocation. It's not algorithmic trading gone wrong. The deceleration is fully visible in the official financial reporting. I mean, look at Bloomberg's comprehensive August 2025 report.
Oh, yeah. The August 2025 piece.
Exactly. Bloomberg explicitly characterized the company's trajectory as delivering its worst growth in years. And that visible deceleration illustrates that the market is actually reacting entirely rationally to a legitimate deterioration in end-user sales velocity.
Right, the market isn't stupid. It sees the cash flow predictability weakening, which leads us to the third point of consensus. The actual mechanical nature of the economic moat that produces those 90% gross margins in the first place.
Right, the social signaling.
Exactly. The moat is inextricably tied to social signaling. Those margins don't exist because the liquid tastes objectively superior to a competitor's bottle that costs 1/10 the price. The margins exist exclusively because the product effectively facilitates high-stakes corporate gifting, it solidifies complex bureaucratic banquets, and then acts as a universally recognized liquid store of relational value.
Liquid store of value. I like that phrasing. So the value of the asset is entirely derived from its utility as a social lubricant in these high-leverage situations.
Precisely. And to fully understand the vulnerability of that moat, and also the potential resilience of it, we really have to analyze the most relevant historical precedent, the 2012 to 2014 anti-corruption shock.
Yes. Let's go over that in full, because I think a lot of newer allocators forget just how violent that period was.
It was incredibly violent.
Yeah.
So in late 2012, the state initiated this sweeping, highly publicized anti-corruption campaign. And it systematically targeted lavish bureaucratic banqueting and the use of public funds for official gifting.
And before that, government procurement was a massive pillar of Moutai's revenue, right?
Huge, a highly predictable pillar. So this immediate regulatory shock just crushed demand overnight. The pricing impact across the secondary market was catastrophic. I mean, the wholesale price of a standard bottle of Moutai plummeted from over 2,000 yuan all the way down to roughly 800 to 900 yuan.
Over a 50% drop in the physical product's wholesale price.
Right. And consequently, as those earnings projections collapsed, the equity experienced a severe drawdown, dropping approximately 60% from its previous highs.
A 60% haircut. But, and this is the punchline of this specific historical event, they adapted, didn't they?
They did. And the underlying mechanics of that adaptation are paramount for your underwriting process today. Because yes, the immediate reaction was panic, but the subsequent reality was pure adaptation. Moutai strategically shifted its distribution focus away from relying on government procurement. They recalibrated their entire marketing and distribution networks to target the rapidly expanding base of civilian consumption and private household wealth.
So they essentially swapped out toxic government demand for insulated private demand.
Exactly. And following that structural pivot, the demand profile normalized under a new demographic. The stock recovered powerfully.
Right.
It ultimately rose roughly 10 times from those lows into its absolute peak in February 2021.
A 10x recovery. So the overarching lesson of the 2012 to 2014 shock is that the franchise is undeniably politically exposed, but it's not inherently fragile. It proved it has the operational capacity to reroute its demand structure under severe regulatory duress.
Exactly. It's neither indestructible nor fragile.
Which, I mean, that specific 2012 to 2014 survival narrative serves as the direct foundational pivot for the current bull case today.
It's the entire bedrock of the whole case, yeah.
Right. Institutional investors who are actively accumulating the stock right now at 1,413.64 yuan, they are essentially positioning their portfolios for a direct repeat of this historical resilience. And within our framework, we classify this specific type of positioning as late phase 4 selective accumulation.
Right, which we'll map out on the market clock in a minute.
Yes, but first, we need to outline the 5 distinct pillars that structurally support this bull case. Let's walk through the mechanics of each one. The first pillar is economic gravity.
Right. Economic gravity. And to understand why a 30% ROIC matters when growth is slowing down, we have to utilize Olson's residual income framework.
Let's unpack that framework carefully because it really is the mathematical bedrock of the accumulation thesis here.
Yeah. So traditional valuation models like standard DCF, they rely entirely on discounting future cash flows, right?
Yeah.
Which basically forces you to make highly speculative assumptions about what growth is going to look like a decade from now.
Which is basically guessing, especially in a transition regime.
Exactly. It's guessing. But Olson's framework offers a much more grounded approach. It dictates that a company's true equity value is its current book value plus the present value of all expected future residual income.
And residual income mathematically is defined as the net operating profit a firm generates above its true cost of capital.
Right. And look, in highly competitive free markets, most companies eventually see their returns mean revert downward to match their cost of capital as competitors enter the space. The residual income trends towards zero. But Moutai, because Moutai sustains an ROIC above 30%, while its cost of capital sits down in the single digits, it just continuously generates massive compounding residual income.
And high persistence economics of that magnitude mathematically command a premium valuation over book value.
Exactly. This persistent spread acts as a gravitational force. It effectively limits the downside risk of the equity, even in a completely zero-growth environment.
Okay, so that's the first pillar, the math. But the mathematics of the Olson framework are only undeniable, provided the underlying business model remains intact. Which brings us to the second pillar of the bull case. Structural scarcity.
Yes, structural scarcity. Because the supply side of this asset is rigidly and permanently constrained by both physical and biological realities, Kweichow Moutai cannot just, they can't simply build another factory in a different province to double production.
Right. The manufacturing process is strictly limited to that highly protected microscopic geographic footprint along the Chishui River in Guizhou province.
Exactly. That specific environment has a unique microbial ecology that is absolutely required for the fermentation. And furthermore, the complex sauce aroma fermentation and distillation process, you can't technologically accelerate it.
You can't just run the machines faster.
No, you can't. There's a mandatory multi-year aging cycle. It requires the liquid to be stored in specialized earthenware jars for a minimum of 5 years before blending and bottling. So that creates a hard, unyielding cap on supply elasticity.
And in the consumer goods sector, we frequently see management teams destroy brand equity by strategically overproducing during boom times. But Moutai's biological and geographic constraints physically prevent them from overproducing.
Right. It effectively guarantees supply discipline regardless of management's ambitions.
Which leads us to the third pillar, cultural embedment. This brings our focus back to the Lunar New Year 2026 data we discussed. Because despite severe macroeconomic headwinds and negative wealth effects in the property sector, the ceremonial infrastructure of Chinese society still heavily utilizes Moutai as its primary liquid currency.
Yeah, for major life events, crucial business negotiations, intergenerational wealth transfers, that cultural reflex to utilize this specific product remains deeply embedded.
And the fourth pillar is that historical precedent we detailed earlier, the 2012 to 2014 shock. The asset has empirically proven its ability to survive regime stress by rerouting toxic demand. But I want to spend some time on the fifth pillar because this provides the most compelling forward-looking framework for allocators.
Right, the comparative luxury logic.
Yes. The behavior of absolute apex luxury assets during severe global economic contractions. It provides a really clear, actionable roadmap for underwriting Moutai today.
And we have to talk about Hermes in the aftermath of the 2008 global financial crisis.
Oh, absolutely. This is the perfect analogy. So, following the collapse of Lehman Brothers in 2008, global luxury demand faced deep, sustained cyclical weakness, right? And what happened was the broad aspirational brands, the ones relying on middle-class consumers stretching their budgets to buy like entry-level luxury items, they suffered massive, devastating revenue collapses.
And they were forced into aggressive discounting, which severely damaged their brand equity.
Exactly. But Hermes, the French luxury house, demonstrated profound counterintuitive resilience. Hermes did not discount. They completely maintained their wait lists for the Birkin bag.
So what's the ultimate punchline of that Hermes story for Moutai investors? The punchline is that Hermes' ultra-high-end positioning, their ruthless supply discipline, and their unquestioned status function allowed them to recover significantly faster and stronger than their weaker aspirational peers. It wasn't that Hermes was magically immune to the 2008 crisis. It was about the rigorous filtration of the client base.
Right. Strong symbolic monopolies emerge stronger from economic crises because they exclusively capture the remaining liquidity of the ultra-wealthy. And the ultra-wealthy are insulated from standard economic shocks.
Exactly. The bull case essentially argues that Moutai is executing this exact Hermes-style filtration process right now.
And to reinforce that comparative luxury logic, we have quantitative behavioral finance metrics that strongly support this selective accumulation thesis.
Okay.
Let's map the current price action onto the behavioral models. The stock is currently situated at a 5.00 position on the market clock.
Right, the market clock framework.
Yeah, for those unfamiliar, it visualizes the psychological cycle of an asset. Phase 1 is stealth accumulation, Phase 2 is the public markup, Phase 3 is the euphoric top, and Phase 4 is the markdown and capitulation phase. At 5:00 on this clock, we are at the very end of Phase 4.
The very end. The previously dominant growth narrative is completely broken. The momentum investors, the guys who require accelerating revenue to justify their positions, they have entirely evacuated the asset. That previous era of absolute certainty regarding the stock's upward trajectory has just completely evaporated.
Furthermore, proprietary quantitative systems show an extreme behavioral scan of 14 out of 20, combined with that severe 46% drawdown from the peak. And that 14 out of 20 extreme scan indicates that all market euphoria has been systematically purged from the shareholder base.
Right, we're operating in an environment characterized by selective pessimism now. And historically, acquiring monopolies boasting 30% ROIC during periods of extreme selective pessimism, that represents the precise setup required for generating outsized long-term forward returns.
Okay, so that establishes a very robust, mathematically supported bull case. But we must now pivot abruptly to the bear case, because the bear case fundamentally challenges the long-term durability of those exact ROIC metrics we just praised.
It does. It demands that you entirely discard the consumer staples label and frame Moutai explicitly as a Veblen good.
We need to define the mechanics of Veblen economics so allocators truly understand the risk here. In standard supply and demand theory, a higher price reduces demand. But in Veblen economics,
In Veblen economics, the high price is not a barrier to entry. The astronomically high price is an intrinsic, non-negotiable feature of the product's social utility.
right, it derives its entire relational value precisely because everyone in the room knows it is excruciatingly expensive and highly exclusive. It proves the purchaser has excess capital to burn.
Exactly. But, and here is the risk, if the sociological value of displaying that excess wealth diminishes, either through cultural evolution or political pressure, the demand curve doesn't just soften, it structurally collapses.
Which brings us to the 5 structurally severe arguments building the bear case against Moutai right now. Argument 1 is the direct policy impact.
Right, the common prosperity framework. This policy framework enacted by the state directly impairs the company's economic moat. It achieves this by rendering highly visible, ostentatious prestige consumption politically unattractive, if not outright dangerous, for corporate executives and high net worth individuals. I mean, if displaying wealth invites regulatory scrutiny, the utility of a Veblen good instantly evaporates.
which is a terrifying prospect for a luxury asset. Argument 2 highlights the broader, more insidious structural shifts occurring in the consumer base today, particularly when compared to that 2013 shock we talked about.
Yeah, the demographics are very different now. In 2013, the headwind was strictly a top-down, channel-specific regulatory mandate targeting government officials. Today, the headwinds are fundamental. We are observing structural demographic decline, a shrinking overall population, coupled with a younger generation that is actively pivoting their consumption habits.
Right, they are moving away from high-proof traditional Baijiu and moving toward imported beer, fine wine, single malt whiskey, craft cocktails.
Exactly. And crucially, this younger demographic lacks the ingrained institutional reverence for the rigid Baijiu drinking rituals that completely defined their parents' and grandparents' generations.
And if the ritual dies, the product becomes merely an overpriced liquid.
Just expensive alcohol. Yes.
Argument 3 attacks the bull case's valuation theory directly, because a 25 times price to earnings multiple is only considered cheap relative to the historical euphoric 70 times multiple. In absolute terms, 25 times earnings still implies robust future growth.
It absolutely does. If terminal growth assumptions for this business have structurally reset from reliable double-digit expansion down to low single-digit stagnation, and simultaneously the required equity risk premium has expanded due to ongoing regulatory uncertainty, then 25 times earnings is not deep value.
It's merely fair value, or far more dangerously, a classic value trap.
Yeah.
Now, Argument 4 centers squarely on the concept of political asymmetry. And as a principal investor, you must acknowledge that the regulatory landscape in this specific jurisdiction possesses the absolute capability to rewrite industry economics instantaneously.
And we have a perfect, terrifying example for early investors: the new Oriental and teleeducation policy shock of 2021.
Let's review the mechanics of that event in full. The private tutoring sector in China was generating massive free cash flow, boasting high margins, commanding premium multiples.
That's familiar.
Exactly. However, the government abruptly determined that the private tutoring sector's core social function, which was essentially profiting from the intense academic anxiety of parents, was fundamentally misaligned with national demographic goals aimed at boosting the birth rate.
Right. And overnight, highly profitable, high-return businesses were structurally dismantled via regulatory decree, rendering the equities virtually worthless.
Now, while premium liquor is clearly not private education, the underlying investment principle is identical and highly applicable. Exceptional accounting profitability and pristine gross margins offer absolutely zero protection to a business whose fundamental social function becomes politically inconvenient or counterproductive to the objectives of the state.
None whatsoever. Which leads us to argument 5, which addresses a deeply technical but vital risk: the critical divergence between actual channel health and reported accounting earnings.
Right, because it is entirely possible for the income statement to present a comforting facade of stability while the underlying physical distribution network rots from within.
Exactly. Here's how this mechanism functions. The powerful wholesale distributors, they rely on Moutai for their livelihood. They may continue aggressively purchasing inventory from the manufacturer even when end-user demand is weak, simply to maintain their lucrative, highly coveted future allocations.
Because the factory ships the product and receives cash, so Moutai reports revenue resilience and continued earnings growth.
Yes. However, if this physical inventory is merely piling up in massive wholesale warehouses, rather than flowing through to the end consumer at banquets and weddings, the system is fundamentally unbalanced. The wholesale-retail price spreads will inevitably begin to deteriorate as distributors quietly try to offload excess stock.
Okay, I must challenge you directly on this fifth point regarding channel health, because it is the most difficult variable to isolate. As a principal investor allocating capital from an office thousands of miles away, how exactly can one decipher if the reported financial resilience in the quarterly filings is legitimate?
You really can't use the filings for that.
Right. How do we know it isn't merely masking a massive systemic inventory buildup? If the wholesale-retail spreads are silently deteriorating while end demand fades, the financial statements will not explicitly flag this channel stuffing until the absolute breaking point is reached and orders suddenly halt. How do we measure the rot before the collapse?
It's a great question. You cannot rely on the official quarterly filings to detect this specific risk. The accounting data is inherently backward-looking. You decipher channel health by rigorously and continuously tracking the secondary and tertiary wholesale market pricing mechanisms.
So, tracking the actual street price.
Yes. You must monitor the real-time cash spread between the factory ex-works price, the price the distributor pays Moutai, and the actual unboxed transaction price on the street between merchants. Let's walk through a hypothetical scenario. When the company reports quarterly revenue growth of 10%, but your high-frequency data shows the wholesale street premium contracting by 15% in that exact same quarter, you have positively identified channel stuffing.
Because the distributors are swallowing inventory they can't move.
Exactly. They cannot quickly move it, and they are absorbing the margin compression themselves just to maintain their elite agency status with the factory. And when that wholesale premium spread compresses to zero, the entire distribution mechanism instantly halts. Distributors will refuse new shipments, and the reported earnings will immediately collapse.
So monitoring that spread is critical. This complex tension between enduring brand equity and sudden regulatory obsolescence necessitates a reframing of the asset class entirely. We must transition away from standard financial models and utilize the conceptual analogies provided in our briefing parameters to truly grasp the risk profile.
Right. The analogies are key here.
The first analogy is the Veblen good dynamic we just discussed in depth, where the high price is not a flaw or a bug in the system. The high price is the core utility of the product itself. The second analogy compares Kweichow Moutai to the Eastman Kodak company.
Which is a terrifying parallel for long-term holders.
Absolutely, because Kodak continued optimizing its legacy chemical film ecosystem with breathtaking operational efficiency. They generated massive free cash flows, maintained high margins for years, all while the core demographic quietly and permanently migrated to digital ecosystems. Kodak failed not because they made bad film, but because society stopped needing film to capture memories.
And the third analogy categorizes Moutai not as a consumer staple, but as a cultural artifact.
Yeah.
Or a religious relic.
Right. Its equity value relies entirely on a collective, societal belief system regarding its power to confer status. Pristine accounting strength, a flawless balance sheet overflowing with cash, and a 30% ROIC cannot save the equity premium if the underlying societal belief in the relic's power weakens.
And to crystallize this specific risk regarding the erosion of cultural belief, we must deeply analyze the Japanese post-bubble luxury and sake parallel. This is perhaps the most accurate historical template available to us.
Walk us through the Japan parallel.
So, following the spectacular collapse of the Japanese asset price bubble in the early 1990s, the domestic luxury market didn't immediately implode, nor did the physical quality of Japanese luxury products degrade in any way. Instead, the consumption of luxury fundamentally lost its cultural urgency.
Because displaying wealth became taboo?
Exactly. After a decade of euphoric excess, the highly visible display of extreme wealth became socially restrained. It was increasingly viewed by the broader public as gauche, insensitive, and just completely out of touch with the new macroeconomic reality of the lost decade. And for sake specifically, the dynamics were even more pronounced.
Because sake had a similar corporate function to Baijiu, right?
Right. Premium sake held a sacred, deeply embedded position in Japanese corporate entertainment and strict social hierarchies throughout the 1980s. However, as the economy stagnated, sake faced a devastating cultural re-ranking. The younger demographics coming of age in the 1990s organically shifted their preference toward imported beer, Western wine, and spirits.
They associated sake with the rigid, stressful corporate culture of their older superiors.
Exactly. So the structural danger facing Moutai today is not immediate catastrophic financial ruin or bankruptcy. The risk is a slow, grinding migration of symbolic relevance. It is the steady erosion of its status as the ultimate corporate currency, resulting in a permanent, irreversible, multiple compression for the equity.
And this slow erosion of collective belief leads us directly into the critical wildcard metric that governs this entire investment thesis. Who exactly is actually taking delivery of the physical bottles today? We must define the decisive variable for future returns, the quality of end demand replacement.
The end demand composition.
Yes. The core question you must answer is whether the toxic, politically exposed gifting and corporate banqueting demand is being organically and sustainably replaced by genuine, decentralized, private household consumption. Or conversely, is the current reported sales volume merely a mirage created by aggressive channel stuffing from distributors who are purely speculating on future scarcity?
And to solve this wildcard, the historical lesson of 2012 and 2013 is absolute. It provides our guiding light here. Because the sustained multi-year equity recovery that followed that massive drawdown, it didn't materialize from Moutai successfully preserving or reviving the old toxic government demand channels.
Right.
The recovery materialized precisely because Moutai's management successfully replaced that politically exposed demand with better, highly durable, and highly diversified private household demand. Everyday wealthy citizens began drinking it at private family gatherings. The institutional market today cares very little about how many metric tons of liquid are physically leaving the Kweichow production facilities.
They care about who is drinking it.
Yes. The market is exclusively and ruthlessly focused on the re-legitimation of Moutai's social function among a new, younger, and politically insulated demographic. If household consumption replaces corporate bribery, the multiple will expand. If it does not, the multiple will continue to compress.
So we must now synthesize these opposing forces, the world-class economics against the shifting cultural tides, to effectively navigate what is currently the valley of despair. Kweichow Moutai, trading at 1,413.64 yuan, is unequivocally caught in a major regime transition.
Absolutely.
We reiterate the quantitative positioning. The asset sits exactly at 5.0 on the market clock. It is late phase 4. As an allocator, you are currently operating deep within the valley of despair. And within our institutional valuation framework, we recognize two massive green gravity walls that protect the asset from permanent capital impairment.
The margins and the efficiency.
Right. The absolute gross margins above 90% and the pristine capital efficiency demonstrated by the 30% ROIC. These metrics provide a hard floor against catastrophic downside. Conversely, we face two imposing yellow walls that demand strict caution and actively prohibit aggressive maximum conviction buying,
which are demonstrably decelerating revenue growth and structurally higher discount rates applied to the Chinese equity market.
Exactly. The extreme behavioral score of 14 out of 20 confirms the setup is mathematically compelling and asymmetrical, but the fundamental operational turn in the underlying business is not yet confirmed by the data.
No, it's not. And managing capital during this specific transition from Phase 4 markdown into Phase 1 stealth accumulation is honestly the most difficult and psychologically taxing maneuver in portfolio management. The Phase 4 cycle only transitions to Phase 1 when three massive variables universally align. Macroeconomic policy tone must soften, broader consumer culture must stabilize, and granular channel inventory data must clear.
It doesn't just turn because the PE ratio hit 25.
Exactly. The cycle does not automatically turn simply because the price-to-earnings ratio appears optically cheap on a historical 10-year chart. A 25 times multiple is a completely meaningless anchor if the earnings denominator itself is artificially elevated, masking a structural, long-term deterioration in actual end-user consumption.
Which brings us directly to the execution blueprint. We must translate this complex theoretical analysis into actionable directives. What this means for your portfolio today. We will now strictly outline the 7 portfolio recommendations based exclusively on the current data parameters we have discussed.
Let's walk through the numbers.
Recommendation 1. Staged accumulation. At the current market price of exactly 1,413.64 yuan and a valuation multiple of roughly 25 times earnings, you are authorized to take a 2% to 3% initial portfolio allocation. You will not deploy your full weighting immediately. You will only add to this initial position as fundamental empirical confirmation emerges over a strict 12 to 18-month horizon.
Right. And recommendation 2 is the channel health trigger. You will closely monitor top-line reporting metrics, but reported revenue growth above the 5% threshold for 2 consecutive quarters is only to be considered a constructive buy signal if and only if underlying channel conditions are demonstrably healthy. Any revenue growth driven by distributor margin compression or obvious inventory stuffing must be entirely discounted from your models.
Recommendation 3 is the policy stability target. If the state's posture toward premium, highly visible consumption remains strictly rhetorical, meaning it's confined to speeches and editorials without legislative action. A 3% to 5% total portfolio weight is highly defensible for this asset. However, if the regulatory policy becomes explicitly hostile, or if the government introduces direct punitive taxation specifically targeting premium liquor, you must immediately and ruthlessly cut your exposure to 0.
Recommendation 4 outlines the 3 confirmation catalysts. Before increasing your allocation, you must require a sustained wholesale price recovery on the secondary market that persists well beyond predictable seasonal events like the Lunar New Year. Second, you must see a credible factory price hike initiated by management that is fully and seamlessly absorbed by the end consumer without causing channel stress or inventory pileups. Finally, you must identify broader macroeconomic consumption support that actively lifts all premium consumption occasions globally. You must require absolute confirmation of at least two of these three catalysts to trust and financially participate in any sustained equity rally.
Recommendation 5 demands that you discard 2021 anchors. You must permanently erase the old 70 times multiple from your financial models and psychological expectations. It is a relic of a bygone macroeconomic era. You will strictly underwrite this asset based on today's elevated risk premium and lower terminal growth rate.
Which is incredibly hard for veteran investors to do, but it's vital.
Absolutely. Recommendation 6 outlines the pairing strategy. To mitigate specific cultural risk, you must actively balance your Moutai exposure with premium consumer equities in other jurisdictions that are fundamentally less dependent on corporate banqueting and highly visible, politically sensitive status display.
And finally, Recommendation 7 establishes the hard risk triggers. You will completely halt all staged accumulation if reported revenue growth falls below the 5% threshold for 2 consecutive quarters, or if official anti-luxury rhetoric demonstrably escalates in state media. You will only scale to your full maximum 3% to 5% position over the mandated 12-month period if all quantitative pricing metrics and qualitative policy indicators improve in unison.
To summarize the bottom line of this briefing, Kweichow Moutai is currently a conditional franchise buy. It remains a politically exposed luxury monopoly possessing magnificent world-class unit economics that serve as a powerful gravitational floor. However, its historical social premium, the very foundation of its Veblen pricing power, is currently under severe systemic question due to demographic shifts in state policy.
Moutai will not bottom when it looks cheap. It will bottom when China decides this kind of status still deserves a premium.
This is the research desk officially signing off.